Okay, we got a bonus episode of rental house versus high income ETFs. I'll call this episode 10.1.1. So my naming system is kind of like software. So this is a month number 10. Video number 1 was actually 10.0. Then I had 10.1. This is a mini update midweek. So I'll call it 10.1.1 bonus episodes. I want to show a couple things. People have been asking some questions, and I sometimes sneak the questions and answers into the regular videos, or I'll answer in YouTube. But I just thought I'd make a bonus video here. The series is called Rental House versus High Income ETFs. It could just be a project investing in high income ETFs. It's just 70,000 put into some covered calls and using margin, just see how it would go. But since that money came from a rental property that we sold, I thought I'd compare the two just to see how things have been going. If you have not subscribed, I would love it if you would subscribe. Just hit the subscribe button. I'd be grateful. And another thing I hate to push this too much, but since I retired in April, I've been spending a lot of my time restoring headstones where some ancestors are buried. Some of these tombstones go back to the 1840s, all the time this area was settled in northern Illinois, and been finding broken buried tombstones. I've been digging them up, cleaning them, gluing them back together with a special adhesive, resetting them into custom made bases that I'm making out of concrete. So all that material is costing money, and you can help by making a donation here to this Buy Me Coffee. I'm not going to buy coffee with this money. I'm actually going to buy materials to continue working on the tombstones. So I would appreciate that if you could do that. Questions. Let's go ahead and look at these questions people have been, I put them all into a group here. So question number 1, how are your covered call ETFs generating such a high return compared to the rental house? Covered call ETFs are earning premium by selling covered calls on the shares that they own, either synthetic or actually owning the shares. I'm not going to get to a lot of details about how that works. There's a lot of videos how synthetic positions work compared to holding the positions themselves and selling covered calls. I'm not going to get into to try and describe any of that stuff in this video because this video is just basically to answer questions. So basically, the ETFs are using covered calls to generate extra income that they distribute to the shareholders. And it's like I explained to my wife, imagine if a price of stock goes basically sideways, it goes up 1%, goes down 1%. It just moves that way forever sideways. What if you could time it, and when it would drop 1%, buy a share, and when it goes up 1%, sell a share, and just keep like buying and selling as it moves up, like timing the market? Not really, but the cover calls are the same thing. With the cover call, you're selling the option for someone to buy it at a higher price. If it doesn't quite hit that price, nothing happens. You don't sell your stock, but you earn a little bit of a premium. You earn money by giving the other person that option. So you're like skimming a little bit off the top in a way. It's hard to explain, but there's a lot of videos on how cover calls work and cash secured puts. And I actually use those in a different account I have, and actually a retirement account. That way I don't have to keep track of all the buys and sells for tax purposes. These ETFs, they do it for you. And so that's why I use those, and that's how they're able to generate some higher income. All right. So question number 2, why do I use margin on my portfolio and how do you manage your risks? So I use the margin to accelerate the amount of growth, and it gives me more money to invest. So basically, I'm earning close to 30% in returns. So the distributions I'm getting are about 30% off what I have invested. And let's jump to this Excel file here in a second here, and I'll show you something here. We don't want that one. We want rate of return. So these are the different ETFs I have and how many shares. So QDTE, and I just recently bought MAGY and I bought some more QQQI. So this is the price today. This is the average cost. You can see that I actually paid more for QDTE and AIPI than what it's really worth. But this rate is the rate of return on the current price. So I'm earning 35% on the $35 per share. And same for AIPI. SPYI, I'm earning about 12% on the 51.37. In QQQI, I'm earning 14%, GIIAX 24%, and the new one I just bought, the MAGY, I'll call it MAGY, I guess, 35%. And so the annual distributions are right here. Monthly distributions are here. So here's the average annual percent return over here. Now, it's not weighted quite right, so that's really, this is just an average of these right here. It's probably close to that though. Okay, I'm earning 31% on annually on these distributions. So here's my annual distributions of 48,985, and this is based on the 158,000. So something else I want to show here, I only invested 70,000. So in reality, if I'm getting these distributions monthly and then annually, I'm going to collect about 48,000 in distributions if I don't invest any more money against my $70,000 investment. So that's nearly a 70% return on the distributions or whatever. But that's not taking consideration the NAV maybe declining when the market goes down. Now, since April, when the market turned around and started coming back up, the NAV has risen. The SPYI has gone up a little bit, QQQI, GIIAX, and then I just bought the MAGY. But AIPI and QDTE, you can see that the average price right now is $43.05 for AIPI, but I paid average of $48. In QDTE, the actual price right now is $35, and what I paid is about $41. So what I really need for things to do is just basically go sideways. And these distributions will stay pretty consistent. And if they do, this is what I'd be earning monthly. Like I said, I don't need the NAV to really go up. I'd be totally happy if it goes sideways, just bounce up and down within a range, maybe slowly up over time. I don't want no big sudden moves the other direction. Question number 3, when did the rental house have appreciated more over time than ETFs? So that answer might be yes, perhaps. So I just got done explaining where I'd be happy if the NAV, the net asset value of those shares, just go sideways. And I'd be happy if I just made money off the covered calls, the income that's distributed monthly, like rent payment. So if I consider this rental house and the ETFs, compare them, the distributions I'm getting from the ETFs is kind of like rent. And as far as the shares appreciating, I don't know if they would appreciate at 4% per year or not. The NAV of QQI and SPYI probably will appreciate about 4%, maybe a little bit less, but most of the money it will earn is off the selling the covered calls. So my answer to this would be they will probably be about equal as far as depreciation. That's not counting the distributions. So just the value of the net asset value. Question 4, why do you prefer ETFs that pay weekly instead of monthly or quarterly? So I had mentioned in a video that a 35% return is a 35% return, no matter if it's weekly or monthly or quarterly. But there's just something exciting about getting those shares weekly. Plus, you can keep an eye on how things are performing if you get a distribution weekly rather than monthly or quarterly. If you get something quarterly and perhaps things are not going well, you're not watching your ETF very closely, at the end of the quarter, you might get a smaller than expected distribution and you don't know why. By getting things monthly or weekly, you have a better idea what's going on, keep an eye on things better. So I think probably the biggest thing is just exciting to get those weekly distributions instead of monthly or quarterly. That's basically the only reason. Number 5, how do you decide which covered call ETF to buy next? One, I like it when the ETF actually owns the shares that they're writing calls on. I mentioned earlier about a synthetic thing where you do a call and a put to emulate the price of the stock to go up and down, but they don't actually buy the stock itself. So I like it when they actually buy the stock and have the stock and then write cover calls against that stock or the ETF, whatever they're using. That way, I'm thinking it would never go to zero. If they actually own something, those companies would have to go to zero for that share to go to zero. If it's synthetic, getting in and out all the time, it could potentially keep going down. They don't actually own it, they're just emulating the price. So I want to buy things that are actually owned. So QDTE uses synthetic. And that wasn't really one of my rules back then, but it is now. So I just bought MAGY and it uses MAGS as what they're buying calls on. And MAGS actually owns the Magnificent Seven stocks, which is like Facebook, Google, Apple, Amazon, Nvidia, Tesla. Yeah, I can't think of who else. But that is why I decide what covered call ETFs to buy next. What's the biggest downside you've experienced so far? It'd be back in April when all the tariff news came and everything took a kind of a crash. That wasn't bad because everything took a crash. So I wasn't upset about that. What I wish is that QDTE and AIPI would have bounced back at about the same rate as the S&P 500 and the QQQ. So I understand that the upside is limited. So because things dropped fast and rose fast, it's not able to rise as fast as the S&P 500 or QQQ if it rises very fast because what's happening, you're writing those cover calls, you're giving somebody the option to buy these shares if they go up to a certain price. When it goes up too fast, whoever has that option to buy those shares are going to buy it because it's a good deal for them. So you're missing out on these quick upward movements. And so that's the biggest downside. But I understand that. So I'd rather have consistent monthly income than a bunch of ups and downs and try to time the market when to sell some shares to take money out and when not to sell shares. So I don't try to time the market. So by earning these premiums, those distributions, that's the money I can use to live off of and pay my bills. So this account, I'm not really taking any money out of it. So what I'm doing with this account is a snapshot of what I'm doing with my retirement accounts. So my retirement accounts, I have a lot of income ETFs and some other types of funds, some preferred stock ETFs, some things like that. They pay anywhere from maybe 7% to 30%. I have a variety of things. I don't share those on the YouTube channel. I may start sharing some of it. I just don't want to share everything I have out to the whole world. So this is the only thing I'm really sharing finance wise, a fraction of what I'm doing as far as the big picture is concerned. I think that answered that question. Number 7, do you ever plan to switch back to owning rental properties? I don't plan on getting rid of any of these ETFs. However, we still have some rental properties. I kept the best ones, the ones that are making the most profit, the ones that were in the best condition, the ones that will appreciate the most, I think, in the next 5 to 10 years. I may buy more if something falls on my lap. So if a good deal comes along, I may buy it. So we have mostly bought things that need cosmetic improvements like paint, maybe some new flooring, maybe a couple windows need to be replaced, maybe a door, things like that. We don't get too crazy with rehabbing, things that we can do ourselves. I'm afraid of heights, so anything that needs a roof on it, I'm not going to do a roof. But I'm not afraid to go in the basement and clean up a basement or something like that. So in other words, do I plan on switching back to owning rental properties? I may pick up more rental properties if the opportunity hits, but I'm not actively going out looking at things on a daily basis or anything like that. So why do you choose to focus only on covered call ETFs instead of mixing in growth ETFs or individual stocks. So I want that monthly premium. Now, as far as total return, I could probably do better if I just bought QQQ and the S&P 500 index funds. Overall, that would probably do better over time. Although some of the QQQ ETF, like QQQI, is doing almost as well as QQQ. By buying the covered call funds, I'm just getting those monthly distributions, and I don't really have to worry about timing the market, selling, when to buy, when to sell. If you're in growth, you're not earning a lot of distributions, a lot of dividends. If you need some income, you got to sell some of your shares. By doing the covered call ETFs, we're not selling shares, we're just getting distributions from those shares. But they don't grow. The NAV doesn't grow like the underlying QQQ or the SPYI. And I'm just throwing those out as two examples. The other thing, which is very important to me, is a thing called return of capital. So by investing in certain ETFs, the money that's returned to you for tax purposes is considered return of capital. So basically, they're just returning my own money to me. So I've already paid taxes on my own money. So when they return to me my own money, I don't have to pay tax on it again because I already paid tax on it. Now, some people will say, isn't that like a Ponzi scheme or a scam or something? So basically, if I gave somebody $1,000, they said they could give me 20% return, and they turn around and give me $200 a year. And then in 5 years, the money's gone because it hasn't earned nothing. They just gave me back my original $1,000. But up till that point, I thought I was getting 20%, but I didn't realize they're just giving my money back and then it went to zero. For tax purposes, that's how it works. But as long as the NAV stays equal by earning these premiums, the return of capital for tax purposes isn't taxed, but my NAV will be there. So at the end of the 5 years, hopefully my $1,000 isn't zero. It's still at least 1,000 or a little more, might be a little bit less, but I'll continue getting those $200 a year in distributions. Hopefully that just goes forever and it never runs out. So once I get that original $1,000 back, it isn't tax-free forever. At that point, the money I get back will be treated as long-term capital gains, which is better than ordinary income as far as being taxed. So I'm not going to go deep into how that works. There's videos on how return of capital works as far as these ETFs are concerned. There's some really good videos out there. But basically, that's one of the ways I choose what ETFs to pick. I like these that are paying high distributions of 30 to 35%, but I also like QQQI and SPYI because during that dip in April and the bounce back, those two performed pretty good during that time. Even though the monthly returns aren't as good, the overall total returns are pretty good. So let's look at a few things here real quick, and then I'll wrap this up. First, I said I bought MAGY. It is paying about 35% return. You can see here. And one of the questions was, how do I pick or why do I pick certain ones? What this is doing is rank cover calls against this fund here called MAGS Holdings. It actually holds these underlining shares here: Apple, Google, Amazon, Meta, which is Facebook, Nvidia, and Microsoft. That was the one I think I was missing earlier, and then also Tesla. So these are the 7 stocks that make up the Magnificent Seven. So this fund owns these 7, and then this fund over here writes covered calls against the MAGs. So I like the fact that this fund is holding something that holds something that's real, not synthetic. Let's jump over here to this total return here. So this website's called totalreturns.com. And I started this project of this cover call thing around November 1st of 2024. So the date's right up there. And this is actually not today. This is Friday. So it's pretty close to being up to date. So the total overall return since November, SPYI is up about 10%. the QQQ is up about 15.5%. So these are the funds down here that I've been holding. So AIPI is up about 11%, so not doing as well as QQQI. GIIAX is about 8%, which is lagging a little bit. I still like that ETF. QDTE, which is the one I put most of my money into, is about 9.5%. So compared to SPYI, the S&P 500, QDTE is just about neck and neck with the S&P 500, even though it uses the QQQ as what it's trading cover calls with. And then SPYI, which is one of my favorites, is at 8%. And compared to the SPY, it's not doing as well total return, but that's okay. And then QQQI is at almost 14%, so not quite as good as QQQ. But like I said, what I like about these two here, what I like about all these here, is I don't have to worry about trying to time the market and sell when things are up and buy when things are down. They use the cover calls to generate that monthly income or weekly income and share it with me. And quickly, let's look at one last thing here. So this is currently what I have in Robinhood, my holdings. Today, I bought 50 shares of MAGY and then 50 shares of QQQI. So I bought some more shares today because I want to continue building position in QQQI and SPYI, but I also wanted to start a position in MAGY. So what I'm probably going to do is every time I buy some of SPYI or QQQI, I'll buy an equal amount of shares of MAGY until I get this to about maybe 500 shares or so. And we'll see how it performs. If it pays consistent and the NAV stays pretty consistent, I'll just continue buying some of this along with QQQI and SPYI. As I said before, I want SPYI and QQQI to be my core holdings for this account. And then the rest of these will just be bonus add-ons. So the core, since I invested 70,000 originally, the goal is to get these two to about 35,000 a piece. And then at that point, I'll just let these ride. And then I'll continue adding other ones that are more high payers. So anyhow, I hope this wasn't too hard to follow. It's just a bunch of added things that people ask me. And I don't like to squeeze them in the weekly videos that I do. I try to keep those more concise, just to the facts, keep them consistent each week of what I'm covering. It's more of an update with how things are going. I didn't want to throw in a bunch of extra and make those longer than what they have to be. So anyhow, don't forget to subscribe and all that good stuff. And I'll give you another update at the end of the week on how the week has gone. Thanks.